Let us see how to calculate debt service coverage ratio in this session. When banks are going to give term loans for projects, they would be interested in understanding the financial viability, and if it is a project that is going to have a direct impact on sales and profits, then they'll be understanding the financial viability using DSCR, a ratio that's nothing but debt service coverage ratio. And if it is going to be other project, say it's not going to have any direct impact on the sales or profits, then they would be making use of FOIR ratio, that is fixed obligation over income ratio. Okay. So in this session, let us focus on DSCR only, how to calculate debt service coverage ratio. For that, let's focus on this project. Okay, so here you have the details of cost of project and means of finance, and the project cost details are available. They are going to purchase land and building, plant and machinery, furniture and fixtures, and all going to cost 37.5 million. And how it has been funded? Owners are funding 9.38 million, and this is nothing but 25% of 37.5 million, and bank is giving 75% of 37.5 million, and it is 28.13. Okay, so the bank would be interested in understanding whether this project would have financial viability, and for that they would be obviously looking for the debt service coverage ratio. Okay, so if you want to calculate debt service coverage ratio, you should know what is going to be the loan amount, we should know what is going to be the interest, and here we have the bank loan amount. And let's assume that this loan is sanctioned, say for a period. I'm going to capture the tenor as 5 years, and let's say the interest rate is something like 10%. Okay, so with this assumption, let us first of all fix the repayment schedule and calculate interest. It means we are going to assume equal principal repayment. Okay, so that is one clause. So if that is going to be the background, let's see how to compute the repayment schedule. So I'm going to make use of this table. Yeah. So here we have a small structure by year, and year 1, 2, 3, 4, 5, then particulars are available. Opening balance, add drawings, less repayment, closing balance. So what is going to be the opening balance? That is the loan that is taken, which is 28.13. Okay. Assuming it was drawn in the beginning of the year, then there is no drawings, additional drawings, and this got to be repaid in 5 equal installment. That is the understanding we have, right? So this 28.13 divided by 5, so 5.63 million should be paid, and closing balance is going to be 28.13 plus drawings. Of course we don't have any drawings, minus repayment, so this is the closing balance 22.5, and average is simple. This 28.13 plus 22.5, that is opening balance plus closing balance, divided by 2, we get 25.31, and on this average balance let us apply 10% interest, and that works out to 2.53. So now let's move on to year 2. Year 2, year 1 closing balance is year 2 opening balance 22.5, no drawings, right? And the repayment is going to be same, 5.63 equal. So closing balance, if I use the formula, I get 16.88. Average balance applying the formula, I get 19.69, and interest at 10% on average balance, I get 1.97. And if I copy this for next 3, 4, 5 years, I get these numbers. Okay, and let me check. If I total all the 5.63, I get 28.13, which is nothing but the loan amount. Okay, now we have the critical information, that is interest. We have the critical information, that is repayment. These are all very critical for our DSCR calculation. Now let's go to the income statement and compute what is the profit that is going to be available for repayment. More than profit, what is important for us is cash profit. So let's go to a statement. Yeah, this is going to be the income statement for year 1, 2, 3, 4, 5, and we have the sales information, then corresponding direct cost, raw material, direct labor, power and fuel, other manufacturing expenses. Then there is a fixed cost, depreciation. Okay, now all these costs were totaled. If you notice, here you have year 1, year 2, year 3, year 4, year 5. Okay, now with this, opening work in progress were added, closing work in progress subtracted. So here we have the total cost of production. Then opening finished goods were added, closing finished goods subtracted, and we have total cost of sales. Then selling and admin and distribution expenses were added. So This along with this is compared with sales of 100, so we get the profit. Let me just show you that. Yeah, so here we have operating profit, which is nothing but sales minus total cost minus selling admin, and in the same way operating profit is calculated for all the other years. And interest on working capital, to deduct, we don't have any working capital, but interest on term loan, how I got these numbers are nothing but something picked up from this interest computation. If you notice, you have 2.53, 1.97, it goes up to 0.28. Yes, so from this operating profit, these interest on term loans were deducted, so we have operating profit after interest. Then if there are any net operating, I mean non-operating income or expenses, they got to be added or subtracted, and assuming no non-operating income, we have profit before tax. And on this, 30% tax rate is applied. Since we are talking about future, directly we are applying on this, so 30% is applied on this. Okay, so we have profit after tax. If any dividends have been distributed, that should also be deducted. In this case, nothing, so this is the retained profit. So now these information are very crucial, because for calculating the debt service coverage ratio, you should know what is the profits that were retained. Okay, because it is from this retained profit the loan principal got to be repaid, but this retained profit is not the exact cash profit, because this is arrived after subtracting one non-cash item called depreciation. Okay, this depreciation does not involve any cash outflow, so we got to add this back. Okay, so let's go to a statement called DSCR computation. So here we have the particulars year 1, 2, 3, 4, 5 and total. Now for just understanding sake, let's capture the sales for all the 5 years. So year 1 it's 100 and we have the corresponding total over here. Year 2 is 100, 10, year 3 110, year 4 121, year 5 121. So the total sales is 562. Now we should take profit after tax, then we should subtract the dividend, and we are supposed to take only the retained profit, but here I'm starting directly from the retained profit. Okay, so what is the retained profit? Let's go and pick up retained profit. Here it is 4.88 for year 1, 5.45 for year 2, 1.64 for year 3, 5.03 for year 4 and 3.67 for year 5. Some small corrections in retained profit that has been taken care. Let's go and check whether we have it. Yes. Okay. Yeah, coming back. So this is all the retained profit, and if I total them, this is the position, which is 26.61. But if you look at the retained profit alone, it's not going to help you to pay the loan, because what is the loan amount? Loan amount is 28.13 million. So that's where the need for computing cash profit arises, because it's not from this profit you are going to pay the loan, you're going to pay the loan from the cash profit. So you have to add back depreciation. We'll say add depreciation. We can pick up the depreciation figure from here. Yeah, we have it 7.5 and it is uniform all the 5 years, and if you total you get 37.5, and if you check, it is also matching with the cost of the project. Okay, so you have 37.5 and this is the retained profit, and if I add this, that is depreciation and retained profit, I get a number. Okay, so I'm going to call this as total source, and it is 12.38, 12.95, 11.59, 13.93 and 13.27, and in total it is 64.11. Now let us capture the repayment obligations. Now we are talking about only the profit which are necessary to pay the principal. And why not interest? Because this is the profit which is after considering the deduction in interest. So let's focus only on principal. Okay, so what is going to be the principal payment? We have it here in interest computation. We have captured the principal repayment, which is 5.63 for all the 5 years, and if you total them, okay, you get 28.13. So now we can calculate, okay, DSCR, that is debt service coverage ratio. It's nothing but this total source divided by principal, and you get 2.2 times 2.3, 2.06, 2.48 and 2.36, and the overall is 2.28. So this is one way of calculating the debt service coverage ratio, which were adopted by certain private sector banks. Okay, but public sector banks, they would be interested in calculating what is known as the gross debt service coverage ratio. So how do they do it? What they do is when they compute this total source, they would also add back the interest on long-term loans. Okay, so what I'm going to do, let me just push them below. And here I'm going to add one more row basically to capture interest on long-term loan. Add interest on, let's say, term loan. Let's go and pick up interest on term loan. We have it here. It's 2.53 year 1, 1.97, 1.41, 0.84 and 0.28, and if we total them we get 7.03. So now we have to add the total source, which is nothing but sum of these three items. So it's 14.91, 14.92, 13, 14.77 and 13.55, and let's see what is going to be the total. The total is 71.14. So now this source is before paying the principal as well as interest. So the denominator should have interest as well, right? So we'll have interest over here, and interest on term loan is so much that we am just copying from there. So 2.53 in year 1, 1.97 year 2, 1.41 year 3, 0.84 year 4, 0.28 year 5, and the total is going to be 7.03. So if I total this, I can say it is going to be the total obligations. Okay, total obligations is going to be this 5.63 plus 2.53. That's going to be 8.16, 7.59, 7.03, 6.47, 5.91, and overall total obligation is 35.16. So I'm highlighting the total source and total obligations. If I calculate a DSCR now by creating a relationship between these two, let's see, and we are going to call that as gross DSCR. Okay, why it is gross? Because we are taking the gross income before even paying the interest on term loan. Okay, so if I do that, it's going to be 14.91 divided by 8.16, and you get it as say 1.83. And if you notice, this is less than this DSCR. So this DSCR will be called as net DSCR. Net DSCR is something where you take not the total source. So again, you have to make some modification in net DSCR calculation. In net DSCR, what you're going to consider is only this retained profit plus depreciation. Okay, you are not adding the interest, and the denominator is going to be only the principal. So you are comparing the cash profit with principal, you get 2.2. In that way, if you recalculate net DSCR, you would get different numbers, and the overall position should also be modified. Overall position is 2.28. So this is your net DSCR, whereas gross DSCR is something where you take total source, you compare it with total obligations. Year 1 it's like this, year 2 it's 1.96, year 3 it is say 13 divided by 7.03, it's 1.85, year 4 2.28, and year 5 2.29, and overall it is 2.02. So this is how debt service coverage ratios are calculated. Okay, but in some private sector banks, it's possible that when they calculate this total source, number one, they do not consider this. It means they are focusing only on net DSCR. But when they calculate the source, apart from adding back the depreciation, they would also add back, let's say, the salaries that were paid to the owners, then interest that were paid on the capital brought in by the owners. So those two items you have to keep in mind.
How to read balance sheet, how to perform financial analysis using ratios, cash flows, fund flows, how to do financial modeling for bank loan purposes using CMA report and cash budget, how to assess credit facilities like cash credit, overdraft, letter of credit, bank guarantee, term loans. If these are all the areas you wish to learn and achieve mastery, we can help you out. Our comprehensive course, Credit and Financial Analysis Mastery, is for you. To know more details, just come and see FAMB. I'll share the details with you.